Wow, what is this? Finally a down day in the market? 5%? Over 5%. Incredible. Did you ever think we would see another big red candle like this again? No, I didn't, of course. Why would a market crash ever happen? And before you say, oh, finally, after naming every single video market crash, AK finally got it right, my response is that no, we don't actually know if this is the beginning of a market crash. These are market reviews that we do every single week trying to figure it out. And I'm recording this on Thursday right now on the big down day. You'll probably see it by Saturday. Who knows what's going to happen tomorrow? It will be interesting to see if this dip gets bought up super quick, if that Powell power is still in place. So let's jump into the data and see what's going on with the markets. Now let's start with a quote from Alan Abelson. This will all end badly. We've not the slightest doubt. And the only question is when. Probably not tomorrow, as we say, but that's as far out as we'll go. And this is a guy making this quote on May 24th, 1993, which, as we know, no, the market did not crash. In fact, it took off on a massive bull run. So it doesn't pay to be a perma-bear. And this is actually taken from Victor Niederhofer's book, Practical Speculation, in the chapter, The Cult of the Bear. Speaking of, in our strategy, which we teach you in this training, if you haven't taken it already, there's a link in this video and down below in the description and comments, we're still long. Has there been volatility? Sure. We've bought and sold the last 3 days in a row, just because the market has been popping and dropping. And we, as always, have our risk control in place, which I know everyone forgets about risk control when the market just goes up day after day. So I'd be lying if I said I wasn't a little bit happy with this down day, because it reminds people, hey, you still got to manage your risk. The stock market is not just putting all your money completely long all the time. That just develops bad habits. And I'll talk about that more in a second. But if you want to see how we do it in up markets or down markets, definitely check out this free training. Moving on, the last video we covered the Investors Intelligence Bull Bear chart. And the spread there was at its widest point since the January of 18 blow off top, meaning people were overly bullish. And this week, of course, we're going to look at more sentiment and positioning. So here's the average exposure index down here, which measures the equity exposure of professional money managers. That's this red line right here, and it's showing the highest level since December 17, and its third highest point in the survey's history. People are long, very long. And what do we know about sentiment and positioning? When it gets too heavy in one way, you got to start looking in the other direction. So if everybody's super bullish, that's when you start looking at the market and thinking, hey, maybe it's about to turn around. And all that extended positioning long is part of the reason why we're seeing such a violent down day today. That's what happens. People get complacent when you see something like this constantly. And then you could feel a little bit of panic when it turns around. We'll have to check in to see how all this sentiment and positioning changes if we are indeed getting a little correction here. So the idea that the Fed has the markets back, Powell's printing, has become a consensus take. Everyone believes it. That, combined with stimulus money and work from home, has led to a large rise in speculative activity amongst retail traders. Everybody's at home believing in Powell throwing their money into the market. So if you look at the open calls to the open puts, it's at an all-time record high. People are going wild, speculating that the market's going to go higher. In Powell, they trust, again leading more evidence that investors are positioned too far in one way. The one group that's not super bullish is large asset allocators and hedge funds. So this chart shows their general equity exposure, and you can see it's pretty low compared to the past. It's still in a post-recession bear market low territory, and even more notable is how long they've been underinvested for. So there's two ways to read this, right? If these guys are the smart money, then they know something is not right and they're staying out of the market. So it might be a leading indicator telling us that things are going to turn around. Or you could read it the other way, saying that, hey, these guys still aren't invested. That means there's a lot of money to still come into this market and push prices higher. So if we had to guess, we would think it's the latter. These guys will eventually change their positioning too and go long. So it's not the end just yet. Now the SPX was above its weekly Bollinger Band, and it was about to knock into the top side of a 2.5-year broadening triangle pattern. That's a mouthful. But you could have expected some resistance there, and this is exactly where we saw things turn around. But the other thing to remember is that we are in a buying climax right now, and buying climaxes last longer than many expect them to. But September is usually the weakest month of the year, and the trend is fragile because it's so overextended. Everyone's too bullish, and the credit markets are telling us that things should be turning around, and we went over that in the last video. So again, looking at this may be the start. A popular chart that was getting passed around this week is the percent of NASDAQ stocks above their 200-day moving average. The more that are above that moving average, the more bullish the market, right? Well, when they were showing the chart, they were only showing it back to 2003 right here, so it looked pretty extreme what was happening now, and this is the green part here. But if you go back past 2003, you could see it's not that crazy, and it can get a lot more overextended, so you can get a lot more stocks above their 200-day. So yeah, tech stocks are definitely extremely overbought, but the point is that just because they're overbought doesn't mean we got to turn bearish, because an overbought market can always become more overbought. Bob Farrow's rule rules talk about that. One of them is that an exponential, rapidly rising or falling markets usually go further than you think, but they do not correct by going sideways. This is also why you just can't look at one indicator and think it's going to tell you everything. That's why we look at so many different things to try to get a broad picture, and even then we're not going to be completely sure. Now in financial markets, everything is relative. So if people are investing in equities, it's because the expected return on bonds is not good. So no one's making their decisions in a vacuum. Whether stocks look good or not is always going to depend on the alternatives, so bonds or other investments like gold. And we've talked about this a lot in the previous few videos, especially when considering gold and precious metals. So if you dig a little deeper, what you're really looking at is the spread between each asset, and that's what we call the risk premium. So this is a chart that kind of shows you a healthy risk premium. You see equities are at the top and cash-like instruments are at the bottom. Treasuries a little bit above cash. And this is the risk return spread, right? So equities out of all of these is the most risky, but you're going to get the highest return as well. But what happens is when the Federal Reserve is manipulating interest rates, which is their job, they end up pulling this treasuries rate lower. So less return because they're holding the interest rates lower. And that creates a larger spread between something like treasuries and equities. And since investors aren't going to make as much money from holding those bonds because the return is lower, because the interest rates are lower, then they got to reach further out on the risk curve to make up for it. So I'm sure you've heard that expression before, and this gives you a good visual to kind of think of it. If treasuries aren't giving them enough return, they got to reach higher and higher and higher. So again, this is what a healthy curve looks like. But eventually, if those bonds returns are manipulated lower by the Federal Reserve, then investors are moving to equities and they bid up those high yield real estate equities, all of those. But that causes the valuations of all those assets to rise as well. You end up paying more and more for the same thing. You're paying more for future cash flows. And yeah, the market goes up, but the spread changes too. So this is what the risk premium ends up looking like. You can see there's not as much difference between something like equities and treasuries and cash. And this is what happens when you keep bidding prices higher and higher, because it becomes riskier and riskier to invest at those higher prices. So the spread gets tighter and tighter the longer the Fed holds those rates down and the more people are buying. And eventually, like I said, the return on equities doesn't look that much better than holding cash, but cash is way less risky. And at that point, there's no incentive for investors to exchange cash, which is a safe asset as you know, for stock, which is a risky one. It becomes a losing proposition because you're not getting enough of a return on stocks. And that's when everything starts turning around. And that's why the Federal Reserve just can't stimulate forever, because this is what happens to the risk premiums. And right now that risk premium is still pretty wide on equities, well above the point that marks most major market tops. And if you look at these charts from Credit Suisse, it shows that the composite fiscal plus monetary policy score is twice as loose today as it was during the GFC, or the Great Financial Crisis. So liquidity is very strong in this market. And we all know liquidity is important for stock prices to keep going up. So we haven't seen that tightening yet because, you know, Powell keeps printing. Now with all this printing, people are going to be worried about the dollar too, right? Everyone's very bearish. Well, we started a dollar series, which I told you guys I was going to update you on. I still got to make that video, but we were talking about how it was looking like there was going to be a short-term reversal in the dollar, as in it was going to jump higher because everyone is so bearish on it, it became overextended. But in fact, the dollar failed to rally last week, and it looks like it's actually just going to break lower. You can see right here, if this line hits this green area, that's where you really hit oversold levels and you can expect to bounce there. But we haven't seen that yet. Right now, it's pointing straight down. You need to see it hit that level and turn around to become bullish again, at least for the short term. We're long-term bears on the dollar though. But this continuing to head lower means that the short term is very bearish. We can expect the dollar to keep falling. Alex did a Twitter thread recently on the idea of bubble rotation. And basically the idea is that the same bubble doesn't happen twice, in a row at least, it'll skip. So commodities right now are one of those bubbles that hit their high in 2008. So the next crash will likely not come from commodities. In fact, they've been underperforming for a long time now. They're trading at all-time lows relative to the market. So if you know they're not going to crash because they're already low, then you can kind of tell that, hey, this might be a good area to look at for the next huge bull market. They're also going to go through a major capital cycle over the coming decade, because over the last decade, CapEx has been cut by more than 40%, meaning these companies just aren't investing because they're still suffering from that bubble pop. But eventually that has to turn around, right? And that's where you're going to see that huge boom period. And here's that 40% cut right here with capital expenditures. Another thing to look at are buybacks, because they have been such a critical part of pushing the market higher. All these companies with all this free money, what do? Buy their own stock back. That pushes prices higher. But this year, buybacks pullbacks are extremely depressed. They just aren't happening like they used to. So it's going to be tough for the bull market to keep going if this key source of demand isn't there. So it's definitely something to watch. Now, like I said, we don't necessarily know whether this is the start of a big correction. It could be, but from the research we just did, it looks like long-term we can still be bullish. But hey, if we could fully predict the stock market, we would have billions of dollars right now. But the thing is, you don't have to predict the stock market. All you really need is a system in place that controls your risks no matter what happens. That's why I said I was a little bit happy to see a down day, because it reminds people of how important that risk control is. Because here's what happens in a market, and this happens some years, where it goes up just nonstop, constantly. And when that happens, the managers that are following good risk control, they usually underperform, because instead of buying every dip blindly, you actually sell off your position. You manage your downside, because again, you can't fully predict whether the market is going to keep going higher. But then what happens? Everyone starts calling those managers stupid, like they don't know what they're doing, because no one's looking at risk adjusted returns. You're no genius for constantly buying the market day after day. I'm happy if people make money like that, but it also develops bad habits. Because yeah, you throw risk control out of the window, because for this period of time, it doesn't make you more money. Which is funny, because I'm talking about this period of time, because I mean, look what just happened in the market. We had that big crash, we avoided it, I was talking about it, I was happy about it. And now look, from there to the top, 74% rise, and that's with the down day today. Before that, it's close to what, 84% from the bottom? Insane. Straight up in a few months. And we all have short memories, so of course we forget that something like this could happen. And this made everyone think that this is exactly how markets are going to go from now on. They're going to fall and then just rebound. So why wouldn't you buy this dip? That's what I'm interested to see here, how much that market sentiment is going to hold in place, because this could very easily turn around quickly and people just buy it up because the sentiment is still there that, hey, Powell has our back. That can't last forever, but that doesn't mean it's going to end today. But again, you go back and forth on this constantly, but at the end of the day, what matters is that you still have that system in place. Quick example with this strategy that I talk about in this training. We actually just got into DocuSign on the 1st, and you see what it did on September 1st. It jumped like crazy. And that's supposedly because Zoom had good results on their earnings. So everyone looked at the next work from home company and launched that higher too. So we got in the first day and the stock shot up, and it shot up the second day too. And on the second day, all of a sudden we were taking some profits. So we took profits here on the second, and we moved our stop up to where we got in originally. And now, as I said, it's Thursday, it broke that stop point and we're sold the whole thing. So we took some profits and then got knocked out. We had 3 trades in 3 days, which rarely happens because it's a longer term system, but the volatility has just been crazy in this market. And look at this candle right here. The day isn't over, but you can see it rebounded from its lows. So this might mean we just got shaken out. And if you want more volatility, well, tomorrow are DocuSign's earnings. So okay, if I'm looking at this thing pre-earnings, it already jumped so much. So how much more is it going to jump after earnings? If expectations are so high already and things are being priced in already, I think there's a lot more room for disappointment. But again, that's just my theory. That's what I would guess. But when the actual earnings come out, we'll see. So by the time this video comes out Saturday, we will see. Or actually, I don't know if they're reporting before market open or after market close. Either way, our system is out and we followed our risk control to a T, even if we're getting shaken out. So would we have made more money if we just stayed in DocuSign? Maybe. We have yet to see. We got to see what the market does, right? But even if we were going to make more money staying in it, if you asked me what I would do 100% of the time, it would be follow the system that I had in place. Because I know with the right system, when you're executing on the right edge over and over again, you're going to make that money. Right now with our system, we're up almost 55%, I think, just this year. So we're doing way better than the market. And that's from controlling our risk. So you never want to judge what's happening with your system on just one trade. Because DocuSign might work out against you. You can't say, oh, risk control is stupid, I should just be buying and staying long the entire time. That's not how it works. That's not how you're going to be successful in the long term when the market changes and it's not just a straight up. Anyways, we talk about it more in this training. Be sure to check it out. I know everyone's thinking you could just buy and hold right now, but that's not going to be the case forever. It might have already changed. So if you want to get the right strategy in place, check out the training. There's a link in this video and down below in the description and comments. And if you like this video, make sure you subscribe for more because we're always reviewing the market. We do it every week. So subscribe and I will see you in the next video. Stay fallible out there. Bye.